Gold held at Brinks, sure. The U.S., I don't think will activate eminent domain. I think it would be far easier for them to go in and take SLV and GLD, which are controlled by JP Morgan and BlackRock, who JP paid the $920 million fine, the largest the Justice Department had ever issued at that point, for manipulating the metals market. It would be much easier for them to do that. I guess if I had to think of one country, and even they disappointed many years ago by closing out things with Viamet and all the Swiss banks, would be Switzerland. They have a history of that. But, the real issue is that I don't think any government these days is really trustworthy. This is why you get the old adage, if you don't hold it, you don't own it. But from a standpoint of building an ecosystem, if any of these countries are going to attempt to integrate gold into the monetary system, you get one chance, because the minute you deviate from transparency and trust, you're done. 2.9 million ounces in one day vault withdrawal is, I think it doesn't prove stress by itself, but it absolutely tells you it's more than just routine warehouse noise. This is way bigger than that. And I think we will continue to see that every single month. If past is prologue, we will continue. I just happen to think that this is a trend that will not stop. And I think that the paper price is the greatest tool of misdirection. And I don't think people quite understand that. And what I mean by that, let me try and give you what I mean by that. And let's use gold as kind of the proxy for understanding that. Gold is like, for example, GLD, which is a proxy for the price of gold. But to me, it's functioning more as a deliverable reservoir. And so what's interesting about it, the big interests in the U.S. do not need to telegraph physical demand by bidding loudly in the open spot market, because that's what a lot of us can analyze. That's what we've been talking about. But what they can do, and these big money interests would be the APs, the authorized participants, JP, Goldman, etc. They can source GLD shares and redeem what's called baskets, which are 100,000 shares minimum, through their channels and receive London good delivery bars. So
you and I can't do this, but these very big players can, right? Yeah.
Right. And so what we saw recently was a very, very large redemption coming out of GLD. And it was like the largest redemption ever in its 20-year history. It was $4.2 billion worth of gold. It was a week or two in a single week, close to all-time high prices. But
violent collapse in the price of silver was not a natural market correction. It was a highly coordinated wealth transfer. While retail investors watched their portfolios bleed out on the screen, the most powerful financial institutions in the world were executing a massive legal raid on the global physical silver supply. The primary weapon used against the public isn't just the futures market. It is the very ETFs that retail investors buy to supposedly protect themselves. Through a hidden structural loophole, massive authorized participants are quietly draining the vaults while leaving the public holding empty paper.
The largest weekly outflow in its 20-year history. Now, the media will frame that as this is, gold at the top, big money is repositioning, they don't trust gold anymore, but I look at it very differently. The combination of massive outflows while prices stay stable, and there's been a little bit of choppiness, but the prices have stayed relatively stable. This is exactly why I believe everyone has a right to be suspicious about this, because when price stays structurally strong, but ETFs are experiencing the largest, outflows ever in the history of the fund, to me, to the media, the interpretation is no one wants gold anymore. But to me, somebody wants bars more than they want the ETF exposure. And this is, to me, what is exactly happening, not just on COMEX, but they're doing the same thing in GLD and SLV, where they can create or redeem baskets, massive amounts with a lot of, let's just say, a lack of transparency. And so what you see is the biggest money in the world pulling every single string they can to take physical possession. And you're seeing these outflows, not just in GLD, but in SLV too. And it's not as easily transparent like you would be if it were coming off the COMEX, which a lot of it would show up in the commitment of traders report and the outflow reports. Again, I go back to what Jim Sinclair and I talked about. That's mope, in my opinion. The conventional wisdom is throwing out the baby with the bathwater. And yes, you get liquidity. I have always felt that was just an excuse. Look, if it's a pretty much agreed upon assessment that the metals markets have been heavily managed, all right? Call it what you want, manipulation or management, it's the same thing. Then the time to manage it is exactly when everyone is freaking out, because the last thing that they want to see is a dumping of dollars and an escalation of gold and silver, because it shines a light on the fragility of the entire system. And so, yes, we can call it throwing out the baby with the bathwater, getting liquidity. It's the most liquid. You can cover your margins. I don't believe that, because most of the people on margin, they don't have an ounce of gold to their name. To me, this is just managing the situation. So when you see the price dropping and the deliveries accelerating, it's almost as like, oh, are they just knocking down the paper price to quell that anxiety? At the same time, give it to me at subsidized prices.
Right, get the best deal they can.
Yes, yeah. And it's like jacking up the margin rates, which squeezed all the speculators. The price collapses, and then you see huge deliveries, like the December delivery, which was the biggest December delivery in the history of the COMEX market for the month of December. You're seeing price really, I think, being misdirection from global demand and from the understanding that gold and silver would be the place to be. And if they're going to knock it down for you, great. We'll stand for delivery at a better price. To me, it's the opposite of what they want you to think. But what you said is conventional wisdom.
Somebody wants bars more than ETF exposure, and that somebody is the global East. For decades, Western financial powers were able to successfully manipulate and suppress the price of precious metals because no one ever actually demanded physical delivery of the metal. But that era of unchecked Western hegemony is violently ending, and the demand for physical delivery is rising.
There still is the rule of law, but it depends how big of what are we talking? Are we talking physical gold held at Brinks? Sure. The U.S., I don't think will activate eminent domain. I think it would be far easier for them to go in and take SLV and GLD, which are controlled by JP Morgan and BlackRock, who JP paid the $920 million fine, the largest the Justice Department had ever issued at that point, for manipulating the metals market. It would be much easier for them to do that. I guess if I had to think of one country, and even they disappointed many years ago by closing out things with Viamet and all the Swiss banks, would be Switzerland. They have a history of that. But, the real issue is that I don't think any government these days is really trustworthy. This is why you get the old adage, if you don't hold it, you don't own it. But from a standpoint of building an ecosystem, if any of these countries are going to attempt to integrate gold into the monetary system, you get one chance, because the minute you deviate from transparency and trust, you're done. And I think that is, that's kind of the reasoning behind what China is trying to do by multi-jurisdictional vaulting in all throughout the Belt Road, which is not just China, it's Asia, it's Africa, it's South America, so that you have all of these vaults in the countries of all of the participants. So the next vault is being built in Saudi Arabia, and as is right now, Saudi Arabia can indeed sell their oil to China for digital yuan, and right now, which it's completed, is redeem those yuan immediately without going back into dollars. They're making it convertible without converting into dollars in the Hong Kong branch of this new Shanghai Metals Exchange. The next one will be in their own backyard in Saudi Arabia. So who do you trust? I don't know. When all the chips are down, yes, I want to trust the U.S. I think Switzerland is a good choice, but I think that is why you're seeing, they see the same thing. That's why you're doing multi-jurisdictional vaults. And that's why the M-Bridge, their cross-border payment system, central bank cross-border payment system for the banks, the vaults are held in the jurisdiction of the countries that are involved. So if India were to have a node in this deal, they would have their own vault with their own gold inside the vault. And the idea is to sprinkle their gold around all of the vaults so that everyone has, their gold dispersed amongst the trading platform, if you will. It's a fair question, an answer that's impossible to get to because desperate governments do desperate things. So how desperate can this get? I guess only time will tell, but I think that is the riddle they're all trying to solve, and certainly a good way to do so is by branching out your vaults into the participating network of countries that are involved in this new system. I spend 3 hours a day, pretty much 7 days a week reading, and while I did come across that story, I have yet to see anything that even begins to show any concern for it. That doesn't mean it's not. And I'm reading everything I can on metals, on economics, on emerging technologies, whatnot. At this point, no, it's still pretty much off the radar, and I don't know. And that, again, I'm not an expert on graphene whatsoever, but I can tell you from what I see, it doesn't seem to be really on the forefront of the minds collectively. And it also shows to me that there's record low open interest, that you've knocked out so much of the speculation. It's not just hedging the way that I use it. It is for hedging. But the way a speculator would look at it is, well, geez, because there was that period of time where silver was going up unabated week over week over week. So they would just buy contracts. And it's important to understand that one contract, COMEX, is 5,000 ounces. And, right. So, again, I'm going back from memory, but sometime in like the beginning of December to hold a 1 ounce or a one COMEX contract of 5,000 ounces. Back then, silver was about $60. $300,000 worth of silver would be controlled by, at the time, roughly only $15,000 in your margin account. So about 20 times leverage. By early January, we were up to over $50,000 or thereabouts in your margin account to control the same amount. And so if you are a speculator, forget about if you're a legitimate hedger or, for a producer, for a company like mine, for a refinery, all of those companies who have legitimate hedging concerns face the same consequences where, if you hold 2 million ounces in your warehouse like we typically would at 5,000 ounces per contract and $50,000 plus margin in your account that just sits there as collateral, you have to have $50 million in your margin account in order to have any type of inventory. That's just silver. Forget about gold and platinum. But if you are a speculator, well, you say, geez, we can control, $300,000 worth of silver and it keeps going up. Let's buy more. Let's buy more. Let's buy more. The day after Christmas, they jacked rates from by 30%, from 15 to 18,000. And then they did it again and again. And then all of a sudden it's $50,000+. And when they jack up margins, if you don't put that money into your margin account by the end of trading, bang, you're liquidated and they will close you out, which selling begets selling, begets selling, begets selling, the price craters. And then the big traders who aren't using margin, they come in and say, thank you very much. We're going to stand for delivery at these subsidized prices. So yes, it was certainly done to cool off speculation and froth because of all of the deliveries that we saw. And it started to create a problem. And it just goes to show the lengths at which the market will do what they can, at least in the COMEX, which is an exchange, versus the London Metals Exchange, which is not. It's a over the counter. It's dealer to dealer. What the lengths that they'll go to protect themselves. But every time they do that, you have to ask at what expense are they doing this? And the expense is lack of trust. And maybe that's why you're seeing the acceleration of deliveries. And I would argue more and more metal ultimately leaving the COMEX ecosystem. When you see 38 million ounces get on a armada of trucks and off they go, you have to understand that those bars, once they are put on that truck and leave. They are out of the ecosystem. In order to get reintroduced, they'd have to be assayed again at a big cost and a big time. Like, they're never coming back. So, yeah, I think all of this starts to creep into the reality that the Western price setting of these commodities, in my mind, ultimately is on a short leash and on a ticking time, ledger where I don't think that they have time on their side. I think ultimately we will see, for example, a BRICS exchange, which will try and, they're talking about building the grain exchange and they're talking about building the metals exchange that will compete with the price setting of the West. And I knew that a long time ago when 2-3 years ago they talked about building the grain exchange, and the gentleman in charge with it in the BRICS countries said, look, here in the global South, we produce and consume more grain than they do in the West, but we have no control over the price that's set on COMEX. And then he said something like, he says, but with the development of the BRICS grain exchange, that will change. Well, the same thing would change with the metals exchanges. And I think they've been using our stupidity in the way that we manage prices against us by standing for delivery. And that's really what's changed everything, Adam, in this entire system, is that no one ever stood for delivery. No one challenged the West. No one challenged hegemony. These countries were not coordinated. They were not motivated, sophisticated, wealthy, and they didn't have the incentive to do it. And they have been for years. That's what I focused on. And then all of a sudden, Trump wins. And what do you know? Those same motivations are appearing here. And I think it's accelerating as well. So you have the most well-informed traders on the globe. Forget well-funded central banks and very, very connected people who know the information. They always ask Wayne Gretzky, how are you so damn good? Well, I never skated to the puck. I skated to where it was going. And that's what these people are doing.